Learn the skills you need for a more financially secure life. But before anything else, don't forget to like, share, and subscribe. We know that the earlier you learn the basics of how money works, the more confident and successful you'll be with your finances later in life. It's never too late to start learning, but it pays to have a head start. The first steps into the world of money start with education. Banking, budgeting, saving, credit, debt, and investing are the pillars that underpin most of the financial decisions that we'll make in our lives. At Investopedia, we have more than 30,000 articles, terms, facts, and videos that explore these topics, and we've spent more than 20 years building and improving our resources to help you make smart financial and investing decisions. This guide is a great place to start, and today is a great day to do it. Let's begin with financial literacy, what it is and how it can improve your life. Key takeaways. Financial literacy is the ability to understand and make use of a variety of financial skills. Financial literacy in the United States is declining at a time when citizens increasingly need to make thoughtful and informed decisions to avoid high levels of debt and have adequate income in retirement. Some of the basics of financial literacy and its practical application in everyday life include banking, budgeting, handling debt and credit, and investing. What is financial literacy? Financial literacy is the ability to understand and make use of a variety of financial skills, including personal financial management, budgeting, and investing. It also means comprehending certain financial principles and concepts, such as the time value of money, compound interest, managing debt, and financial planning. Achieving financial literacy can help individuals avoid making poor financial decisions and help them become self-sufficient and achieve financial stability. Key steps to attaining financial literacy include learning how to create a budget, track spending, pay off debt, and plan for retirement. Educating yourself on these topics also involves learning how money works, setting and achieving financial goals, becoming aware of unethical discriminatory financial practices, and managing financial challenges that life throws your way. The importance of financial literacy. Trends in the United States indicate that Americans' financial literacy is declining. In its National Financial Capability Study, conducted every few years, the Financial Industry Regulatory Authority, FINRA, poses a 5-question test that measures consumers' knowledge about interest, compounding, inflation, diversification, and bond prices. In the latest study, only 34% of those who took the test answered at least 4 out of 5 questions correctly. Point 1. Yet making informed financial decisions is more important than ever. Take retirement planning. Many workers once relied on pension plans to fund their retirement lives, with the financial burden and decision-making for pension funds borne by the companies or governments that sponsored them. Today, few workers get pensions. Some are instead offered the option of participating in a 401k plan, which involves decisions that employees themselves have to make about contribution levels and investment choices. Those without employer options need to actively seek out and open individual retirement accounts, IRAs, and other tax-advantaged retirement accounts. Add to this people's increasing lifespans, leading to longer retirements, Social Security benefits that barely provide enough for basic survival, complicated health and other insurance options, more complex savings and investment instruments to select from, and a plethora of choices from banks, credit unions, brokerage firms, credit card companies, and more. It's clear that financial literacy is a must for making thoughtful and informed decisions, avoiding unnecessary levels of debt, helping family members through these complex decisions, and having adequate income in retirement. Personal finance basics. Personal finance is where financial literacy translates into individual financial decision-making. How do you manage your money? Which savings and investment vehicles are you using? Personal finance is about making and meeting your financial goals, whether owning a home, helping other members of your family, saving for your children's college education, supporting causes that you care about, planning for retirement, or anything else. Among other topics, it encompasses banking, budgeting, handling debt and credit, and investing. Let's take a look at these basics to get you started. Introduction to bank accounts. Bank accounts are typically the first financial account that you'll open and are necessary for major purchases and life events. Here's a breakdown of which bank accounts you should consider, and why they're step 1 in creating a stable financial future. Why do I need a bank account? Though the majority of Americans do have bank accounts, 6% of households in the United States still don't have 1.2. Why is it so important to open a bank account? Because it's safer than holding cash. Assets held in the bank are harder to steal, and in the United States, they're generally insured by the Federal Deposit Insurance Corporation, FDIC. Point 3. That means you always have access to your cash, even if every customer decided to withdraw their money at the same time. Many financial transactions require you to have a bank account too. Use a debit or credit card. Use payment apps like Venmo or PayPal. Write a check. Use an ATM. Buy or rent a home. Receive your paycheck from your employer. Earn interest on your money. Online versus brick-and-mortar banks. When you think of a bank, you probably picture a building. This is called a brick-and-mortar bank. Many brick-and-mortar banks also allow you to open accounts and manage your money online. Some banks are only online and have no physical buildings. These banks typically offer the same services as brick-and-mortar banks, aside from the ability to visit them in person. Which type of bank can I use? Retail banks. This is the most common type of bank at which people have accounts. Retail banks are for-profit companies that offer checking and savings accounts, loans, credit cards, and insurance. Retail banks can have physical, in-person buildings that you can visit, or be online only. Most have both. Banks' online technology tends to be advanced, and they often have more locations and ATMs nationwide than credit unions do. Credit unions. Credit unions provide savings and checking accounts, issue loans, and offer other financial products, just like banks do. However, they are not-for-profit organizations owned by their members. Credit unions tend to have lower fees and better interest rates on savings accounts and loans. Credit unions are sometimes known for providing more personalized customer service, though they usually have far fewer branches and ATMs. Which types of bank accounts can I open? There are three main types of bank accounts that the average person may want to open. Savings account. A savings account is an interest-bearing deposit account held at a bank or other financial institution. Savings accounts typically pay a low interest rate, but their safety and reliability make them a sensible option for saving available cash for short-term needs. They usually have some legal limitations on how often you can withdraw money, but they're generally very flexible, so they're ideal for building an emergency fund, saving for a short-term goal like buying a car or going on vacation, or simply storing extra cash that you don't need in your checking account. Checking account. A checking account is also a deposit account at a bank or other financial institution that allows you to make deposits and withdrawals. Checking accounts are very liquid, meaning that they allow numerous withdrawals per month, as opposed to less liquid savings or investment accounts, though they earn little to no interest. Money can be deposited at banks and ATMs, through direct deposit, or through another type of electronic transfer. Account holders can withdraw funds via banks and ATMs by writing checks or using debit cards linked to their accounts. You may be able to find a checking account with no fees. Others have monthly and other charges, such as for overdrafts or using an out-of-network ATM, based on, for example, how much you keep in the account or whether there's a direct deposit paycheck or automatic withdrawal mortgage payment connected to the account. Lifeline and second chance accounts, available at some banks, can help those who have difficulty qualifying for a traditional checking account. High-yield savings account. A high-yield savings account is another type of savings account that usually pays a much higher rate of interest than a standard savings account. The trade-off for earning more interest on your money is that high-yield accounts tend to require bigger initial deposits, larger minimum balances, and higher fees. What's an emergency fund? An emergency fund is not a specific type of bank account, but can be any source of cash that you've saved to help you handle financial hardships like job losses, medical bills, or car repairs. How they work. Most people use a separate savings account. The account should total enough to cover 3 to 6 months' worth of expenses. Emergency fund money should be off limits for paying regular expenses.